So what is work in progress? Put really simply, work done, not yet invoiced. When we create work in progress, that's positive, and when we reduce it with our invoices, that's represented as a negative. Effectively, a firm turns its effort into cash. There's a lot more information hidden under the surface level. If we drill down, we can actually see what jobs make up those values. My name is Will McTavish, and I'm the CEO and co-founder of Link. We provide practice management for high-performance accounting firms. My goal with these videos is to teach you the art of running a firm, which is centered around 5 core principles and how they all play together. What often separates high-performance firms from average firms is their ability to identify write-offs and use them to their advantage. Many firms ignore write-offs, while others, they use them to attack their team members. Where firms that are winning, they understand the key insights can be used to improve performance. My name is Will McTavish, and I'm the CEO and co-founder of Link, which provides practice management for high-performance accounting firms. I've analysed the data of over 1,000 accounting firms all over the world, which allows me to see what separates the firms that are performing well from those that are struggling. My goal with these videos is to teach you the art of running a firm, which is centered around 5 core principles and how they all play together. In today's video, I'm going to show you how high-performance firms use write-offs to their advantage. Now, to understand write-offs, we first need to understand work in progress. So what is work in progress? Put really simply, work in progress is work done, not yet invoiced. Now, there's an equation we can use to look at work in progress as well. So very simply, it's work done, not yet invoiced, but we can look at work in progress over a period. So in a period, we'd have opening work in progress for the period. We can add time, which has got a billable value to it in the period. We've got disbursements, which are anything that are non-time related, such as subcontractor fees or any travel charges or any accommodation. We've got invoiced, we've got our net write-ups, and that gives us our closing WIP. So if we take all of these values and add them together, we arrive at our closing WIP, noting that invoiced is recognized as a negative. And that's because when we create work in progress, that's positive, and when we reduce it with our invoices, that's represented as a negative. So let's look at an example here for April 2026. Let's say that we open the period with no work in progress, and then we add $600 of time to this job. Now, that could be 3 hours work at $200 an hour, giving us $600 of work in progress. So it gives us closing WIP of $600, right? All makes sense. Now, in May, what would our opening work in progress be? $600, that's right. Let's say we add $200 of time to this job. We'd now have $800 of work in progress. All makes sense? 600 plus 200 gives us 800. Now, let's say we invoiced $1,000 for this job. That's going to be represented by a negative because time increases our work in progress. That's an asset to us. It's billable time. And then we can reduce it by invoicing it. And then we're exchanging the asset, which is our work in progress, for another asset, which is an invoice. And eventually that will become cash in the bank account, another asset. So we reduce our work in progress by invoicing it. That's going to give us negative $200 of work in progress as our closing WIP. But we don't want to hold $200 of negative WIP. Instead, we want to have a write up here. So we've got $200 of write up. So if we take the 600, add 200 and subtract 1,000, and then we add our $200 of write-ups in, we'll arrive at 0 work in progress. And that's going to be the life of this job here. So let's look at a different situation. This time we're going to show a write-off. So let's say we had the $600 of time was our opening WIP. And then we add $1,000 of time, which gives us $1,600 of work in progress. We invoice $1,000, and that's going to give us $600 of work in progress. But we don't want to hold on to this work in progress forever because we've finished the job, we invoiced $1,000, which is what we agreed. So instead, we need to incur a $600 write-off. Now, this is very insightful information now because we know that we've done $1,600 of work. We invoiced $1,000, $600 was written off, and that gives us $0 as our closing work in progress. Now, I'm going to show you one more thing. This is negative work in progress. So we understand that work in progress is work done, not yet invoiced, and that's an asset to us. But we can also have negative work in progress, which you may have guessed is created from invoices. So let's say in April, we start by invoicing $1,000. So we have negative $1,000. So our closing WIP is a negative 1,000. And that's actually cash in my bank account now because we've invoiced it, it's been paid, but we haven't done any work. So it's actually a liability to me, the $1,000, because I still need to do work. Now, in May 2026, we'd open the period up with negative $1,000. And then we put our time in there, which would be $700. That gives us negative 300 as our work in progress. Then we give a write-up of $300, arriving at $0 of work in progress. So although I've called negative WIP a liability, it's actually a good thing. It's because we've had cash in our bank account. It means we've been paid upfront for the work that we're doing. But it does become challenging to track our work in progress of what we need to bill versus what we have invoiced in advance if we are charging on a subscription basis. So if we are doing our accounting fees over 12 monthly invoices, we want to make sure we're separating out our work in progress that we need to bill versus the ones that are built on that retainer or that subscription model. So just something to bear in mind here. But that's negative work in progress. So hopefully by now you've got a general understanding of how work in progress works and the formula. Now we can look at recoverability. So recoverability is the percentage of work performed that converts into billable revenue after adjusting for write-ons and write-offs. So put really simply, it measures how effectively a firm turns its effort into cash. So we've got the WIP equation, which we're familiar with, and this is looking at jobs, right? So we've got our first job here, $3,400, no disbursements. We're going to negative $400 as a write-up, giving us our closing WIP of $0. And then we have our second job here. This one has a write-up. So I've shown you this to highlight that some jobs have write-offs, which is poor recoverability, and then we have some jobs that have write-ups, which is high recoverability. Now, we can look at work in progress from the perspective of jobs, and we can also look at it from a client's perspective. We can also look at WIP in other ways. And we look at team members here. Now, when you look at team members, it does get more complicated because invoices aren't always associated with a team member, but we're going to get into a bit more detail around that shortly. But let's just look at this in terms of our people working on jobs. So let's say we've got Kate here, and she has done in this period $27,500 a time on her jobs. She's invoiced $30,500, giving us $3,000 of net write-ups, which is positive, right? So we have zero closing WIP. And we're just assuming that none of these jobs fall outside of this reporting period here. We're keeping the example nice and simple. Then we've got Ted, who's done $26,300 of WIP. We've got $23,400 invoiced, giving us a write-up of $2,900. Zero closing WIP. So here we can look at this and say Kate has done a great job this month and Ted has done a poor job this month, looking at these numbers at face value. But what I want to show you here is there's a lot more inside these numbers than we can see right now. So let's look at Kate's jobs. So Kate has done these 5 jobs here. Again, WIP, opening WIP, we're keeping it 0, keeping our example nice and simple. That's a breakdown of her time. And here's a breakdown of her invoice values. And then these are her net write-ups. And we say net write-ups rather than write-offs because write-up we want to show as a positive, where a negative would be a write-off. So we just want to make that clear. So if it's a negative, it's a write-off. It's a positive, it's a write-up. So what we can see here is $3,000 of write-offs, but what's actually interesting is we went about job 5. Kate actually wrote up $4,100, so she had this was a great job. So we may want to talk to her about what went so well on this job. What we didn't know, tucked away in her write-ups, was actually a $2,000 write-off for job 4. So this is something we may want to talk to her about because we might want to price this job differently next year. So what I'm trying to highlight here is that there's a lot more information hidden under these surface level write-offs or write-ups. If we drill down, we can actually see what jobs make up those values. Now, if we look at Ted, we've got a very different situation. So Ted here, he's actually had write-ups on all of his jobs, on the first 4 jobs, apart from this last job here, job number 5. Now for job number 5, he's put $11,600 to this job and only invoiced $1,200. Well, we could look at the $2,900 and think, okay, not such a big deal, not a bad month for you, Ted, move on. But in reality, what's happened is there's a huge write-off here. So this could be because we haven't communicated the budget to Ted when he started the job. Our workflow system may not have captured the actual hours he had available on that job. Or perhaps he's just been putting time here when he's been doing other activities. So maybe we've said we need your productivity to be at 80% this month, Ted. And rather than putting his hours down correctly, he's gone to just stash time to this job number 5 here. So there's so many reasons why we've arrived at this massive write-off on this job. But this is a really good conversation we could have with Ted. And we might find out something very insightful. And we can make some changes in our firm to make sure this doesn't happen again. So I just wanted to highlight here the value of looking deeper than the surface level write-offs, to look at them at a job level. And those job levels roll up to the team member write-offs. Now, To investigate write-offs, we like to look at identifying patterns versus outliers, and this is what high-performance firms do really well, is they're able to analyze this data and identify patterns and outliers in the data set. So let's have a look here. So this is what Ted's jobs would look like with an outlier, which we just saw. So we've got this outlier of this write-off as $10,400. That's an outlier in the data, and we can talk to Ted about this outlier. Something happened with the job, right? Now, if we look at this from a pattern perspective, we might have something that looks very different. So the same write-offs, but he's actually had write-offs on every single job. Under this situation here, we'd say that Ted isn't performing at the billable rate we've assigned him. So he's actually not quite achieving the output we'd expect for the rate that we're paying him. So we want to look at encouraging him to figure out how we can lift his write-offs. So same net write-off for the same person, two very, very different situations. And it's about drilling into this data to understand, is this a pattern or is this an outlier? If it's an outlier, it's a problem with the job. If it's a pattern, it's a problem with how our team members are working for the rate that we've assigned them. Not necessarily a bad thing, but it's just something to keep in mind. It's just something to understand how we arrived at those write-offs. Recovered rates allow us to cut through all the noise. So recovered rates are calculated by taking the revenue and dividing by the billable time. And that's going to look at the rate that we actually managed to recover, because we might set someone's billable rate at $200 an hour. We might only be able to recover $180 an hour of that. And we use this to look at what someone's recoverable rate was across multiple jobs. So we can look at this from the perspective of a client, of a job, of a service. There's so many different ways we can look at recovered rates, but it cuts through all the noise because it looks at how much we're actually able to charge. So what's revenue? Revenue is the time added plus the net write-ups. Revenue is a new concept here. We haven't talked about this one yet. And the question is, why use revenue to calculate recovered rates? Why can't we just use invoice? Because we've got our WIP equation, right? And we have invoiced in there. So why aren't we using invoice to calculate our recovered rates? Let's have a look at that. So let's say in April 2026, we have $600 of time added to a job, and we invoice $10,000. So who gets recognized for this $10,000 of invoice total? It's very difficult, right? Because we've had someone do 3 hours at $200 an hour to give us $600. But if we look at someone's recovered rate for this month, we're unable to do that because how do we assign that $10,000? So what we do is we take the time, which is 600, and then we add our 0 write-ups, and that will give us $600 of revenue for April. Now our closing WIP here is going to be negative 9,400. So we've got our 600 less the invoiced of 10 grand gives us 9,400 negative. So this becomes our opening WIP for May. All make sense? Great. So let's say we add $11,000 of time in May, gives us $1,600 of work in progress. And then what we'll do is we will then have a net write-up to remove this work in progress of negative $1,600, which is a write-off of $1,600, giving us 0 work in progress. So if you were to look at this now, if we take our time added being 11,000 and then we subtract our $1,600, we arrive at $9,400 revenue for May. So if we take our revenue in April, which is 600, our revenue in May, which is 9,400, we arrive at the $10,000 we've invoiced. But what we've managed to do is we've managed to deal with the work in progress flowing in and out of periods, and that's why we use revenue to calculate our recovered rates and not use invoice. It's because of the timing of invoices and how they're assigned to the people that are working on the jobs. So it's quite a complex concept there. Hopefully that all made sense. So the next thing is write-ups are indicative of billable rates, which is why recovered rates are so useful. So let's look at an example of this. So let's say Ted's billable rate was $200 an hour. What we'd see, his time added was $26,300, and we wrote off $2,900. Now what we want to do is we want to focus on just the time added and net write-ups, okay? And then we can see our write-up percentage, our revenue hours, and our recovered rate. So our write-up percentage on each of these jobs, so we wrote off 90% of our time on job number 5 here. So overall 11% write-off for Ted for the month. Now that's the revenue generated, because what we've done is we've taken the time and then we've adjusted by the net write-ups, giving us our revenue. And you'll notice that the revenue reconciles back to the invoice totals. And that's because we had no opening and closing work in progress in our WIP equation here in these examples. But if we did have work in progress flowing in and out of periods, the revenue would not align perfectly with the time there. Sorry, with the invoiced. So then we have the hours that went into generating this revenue. And finally, we arrive at our recovered rate. So our first job here, With $2,000 of time to it, we had a write-up of $1,000, so our revenue was $3,000. 10 hours of work went in to generate the $2,000 of time, so our recovered rate was actually $300, so good recoverability on this job. The next one, $440 recovered rate, and all the way at the bottom there, we've got $20.69. You think that's crazy, right? We see recovered rates around $20 all the time. There's always a few jobs or a few clients in a firm that's being charged $15, $20, $25 an hour, and often for a lot of work as well. So this is why it's so interesting to look at recovered rates per client. So if you get your whole client list and sort them from high to low at recovered rate, you're going to find some very deep insights in there. There we go. So overall, $177.95 an hour. And because we know that Ted's billable rate's $200 an hour and we're writing off 11%, that reconciles really nicely with this $177.95 we can see there. Right, so bit of a thought experiment here. Let's put Ted's billable rate up to $600 an hour. So what's going to happen there is he's done the same amount of time, but the actual value of the time added is going to be 3 times, right? So now he's done $78,900 of work. But when we go to invoice it and do our wash-ups, he hasn't actually created that much more value to the market. It's just that we've assigned him a higher billable rate. So he ends up writing off a lot of his time. Huge write-offs. And this is why write-offs are indicative of billable rates, because they always come back to what we actually invoiced. So there we go, huge write-offs. And we could say that you're actually doing a bad job here, Ted. Not quite, it's just that we've set his billable rate too high. The revenue reconciles back once we adjust for the net write-ups. The hours haven't changed, and there we go, recovered rates have not changed. So that's why I say that recovered rates cut through all the noise, because it ignores what your billable rates are, because your write-offs are indicative of billable rates. Therefore, if we look at our recovered rates, we don't worry so much about what those write-offs were. They're still very insightful to know which jobs had write-offs and which ones had big ones on, but if we really want to cut through the noise and see how a staff or a job or a client is performing, recovered rates are a really good tool there. All right, so if revenue is billable time plus net write-ups, which we understand now, and recovered rates are revenue divided by billable time, then average hourly rates are revenue over total time. There's a new concept here, average hourly rates. So recovered rates are fantastic for clients, jobs, and services, and that's because there's no non-billable time that goes into these things here. You don't have non-billable time on clients. You don't have non-billable time on jobs. And our billable services, obviously no non-billable time. Average hourly rates, however, they're fantastic for individuals, teams, and firms, because then what we're doing is we're able to look at the productivity and the recoverability to arrive at these rates. So they're a fantastic way to see how our individuals, teams, and our firm is tracking against what we'd consider industry standards. So what I often say is you can't escape the average hourly rate. What's beautiful about it is, let's say we incentivize our team members to have high productivity. Well, what they can do is they can make sure they're putting all their time to billable jobs, but then that comes through in the write-offs. They end up having to write time off because they've gone and stacked time to a client job. Now, if we go, right, we need your write-offs to be down to 0 or on the positives, and we don't look at productivity, then what we can do is we can put the correct amount of time to each job and then just stash time to non-billable, so our productivity drops, but our recoverability looks good. With the average hourly rate, it considers both of these things together, which is why it's a beautiful metric to look at. So this is Ted's work on his jobs, but let's say that was his work for the month. Now let's look at Ted's monthly performance. So we're going to start bringing some new metrics in here. So we know his billable time, which is from the previous example. We know his time added was 26,300. His net write-ups we're familiar with, his revenue, and his recovered rate. So we already know these things. That was from the previous example we just looked at. Let's introduce some new things here. So his internal time was 28.5 hours. His leave was 8 hours. So the total time he worked was 160 hours this month. So his productivity, 82%, that's awesome. So he's had really high productivity. So his cost, that's the based on what we pay him, $7,200. So the profit is going to be our revenue less our cost, giving us $16,200 profit that we've made on Ted this month. Then we can calculate our ROI, which is our profit divided by cost multiplied by 100 to arrive at this percentage. And finally, from there, we can calculate our average hourly rate, which is taken the revenue divided by, rather than just the billable time to get his recovered rate, we're looking at the total time, which gives us $146.25, and that's Ted's average hourly rate. And it's a fantastic way to see how our team members are performing, how our teams are performing, and just as importantly, or most importantly even, is how's our firm performing against other firms in the industry. So there's a few things I want to touch on around recoverability. So write-ups can be dictated by the margin you put on your disbursements. So we haven't gone into disbursements in any detail at all in this video here. But the margin we put on disbursements is going to dictate the write-offs or write-ups that we're getting. So if we have a contractor who sends us an invoice for $1,000 and then we put a markup of 200% on that, we're going to see 100% markup. We're going to see it cost us $1,000 and we capture $2,000 as the billable value. Well, that's going to have the first chunk out of the revenue or the invoice when we do our wash-ups. So the margin you put on these disbursements has a big impact on the recovered rates we're seeing for our team members. So I'm just highlighting that now for potentially another video here. Reconcile job budgets with the time budgets to improve write-offs. So what we want to do is we want to have a budget for our job, and then we want to make sure that that's represented as a number of hours that each team member gets to do that job, and then our workflow system should be able to track actual hours versus their target hours. And if we can make sure that our team members are trying to keep their actuals under their target hours, recoverability in the firm is going to improve. So that's a really easy way to improve the write-offs. So write-offs are best investigated with patterns and outliers approach like we looked at earlier, because this is where the real detail comes into it. So recoverability is the intersection of productivity and WIP. So productivity looking at the hours, billable versus non-billable. Work in progress is looking at our billable time and our write-offs, which gives us our revenue. And the recoverability or the rates that we're seeing is an intersection of these two concepts together. And the last thing, when I mentioned cost earlier, is what we pay our team member. ROI must be calculated on a variable cost rather than a fixed salary to avoid the death spiral. I won't go into too much detail on that right now, but your cost should be captured based on an hourly rate, and then the hourly cost for that team member should then be multiplied by the number of actual hours they worked this month, and that way we're not going to have things like leave. So if someone takes 2 weeks leave within a month, we're not going to recognize their full salary, otherwise that's going to drop their ROI. We want to make sure that we're looking at the hourly rate multiplied by the hours they actually work, their total time, to calculate that cost. Otherwise, if someone doesn't take their full amount of leave for the year and then they take extra leave the next year, the ROI plummets the following year. So it's very important to make sure that we're not using a fixed salary cost to calculate our ROI, because you're going to find yourself in trouble. So that is how high performance firms use write-off to their advantage. The key thing there is they're actually looking at their write-offs and they're using a pattern versus outliers approach on understanding why these write-offs are occurring, and they're using to have good conversations with their team to learn about where they can focus their efforts to improve their recoverability. They're also looking at recovered rates and also average hourly rates to get an understanding. When you're looking at a lot of data, sometimes these recovered rates and average hourly rates are fantastic at cutting through all the noise. So if you enjoyed this video, I would love to hear what part you found most useful. So let me know in the comments. And if you are running or if you are planning to run a high performance firm at some point in the future, consider subscribing to the channel. So I'm putting out a lot of videos on these topics here. And yeah, I hope your firm is doing awesome, and I look forward to seeing you in the next video.